Hello, welcome once again, guys. It's your guys A Trades taking go through this complete course. We are on this module again about order blocks and breaker blocks, where we shall look later on the Fibonacci levels and the other standard deviation points as we go through. Let's get started. So, an order block is a specific candle or price zone where institutional buyers or sellers place heavy volume prior to an aggressive price expansion. Okay. And again, we are saying we have two types of order blocks. We have the bearish order block, and then we have the bullish order block. Okay. And we are saying these two types of order blocks, okay, are very important in the market. Why? For the bullish order block, we are saying this is the last down close bearish candle immediately preceding a rapid upward rally that breaks market structure. For example, we have this order block here. Okay, so before price rallying up, we left an order block at this point. The last bearish what candle was this one. It was the bearish candle. Okay, it closed bearish. If you know how candles opened from here, went up, came down, and then closed at this point here. So we know this one is an order block. We see how price again now broke structure and rallied up to the upside. Okay, and then we are saying for a bearish order block, this is the last bullish candle immediately preceding a rapid down drop that breaks structure. Again, what we have here, the last bullish candle is here. What happens after it? Price breaks structure and then drops to the downside. So now let's look at the violation rules of this order block. We are saying an order block must create a clear market structure shift. For example, if you are bearish in this case here, we want to see price breaking up, breaking this high, okay, putting in a market structure shift or break of structure to the upside. Same applies to this point here, okay. If price has been bullish, you want to see price breaking this market structure, creating perhaps a market structure shift or a CISD to the downside. Let me try to put it the way you understand it. Just a second. So that's just the same thing. Okay. So we want to see price, okay, breaking to the upside, changing character, okay, or creating market structure shift or changing state of delivery from bearish to bullish. Same applies for the bearish scenario. We want to see if price has been bullish, printing higher high, higher low, higher high. We want to see it again now, change character here, okay, or change state of delivery, and again we push lower. This implies that now what we have left before the change of character or the change in state of delivery is now what we're going to refer to as the order block. Primary points are the open of the OB or it's 50%. So we are seeing the open where this can't open from, it opened here. All right, it opened here, pushed up, and it opened here, pushed down, went up, came and closed here. Okay, and the 50% at this point here. So we shall look more into live chat examples, but let's first look at it to this. Let's take at this example. This, what you are seeing here, is the same as this. All right. For the bullish candle, it was this one here. For the bullish order flow, what happens? Price was bearish here. We left the last bearish candle, and then what happens? Price comes and breaks this market structure here, creating a CISD, pushing impulsively to the upside. What happens when price returns? It comes to this order block and then starts buying. Okay, and then for the bearish scenario, what happens again? We are in the bullish structure here, like we can see here. We are in a bullish structure. What happens? Market comes, puts in this, breaks this, creating changing state of delivery or change of character from bullish momentum to bearish momentum. So we mark this as our order block. Okay. What happened? Price retraces back into the order block and then starts selling. So these are points where uh, institutions leave orders. They are the blueprints. Okay. The blueprints where you can follow like the steps that okay, I want to target at this point. I want to look at this point. All right. So let's look at a breaker block. Just if you remember from the lesson of fair value gap and inverted fair value gap, the same applies here. The invalidated order block becomes what we call the breaker block. Okay, I'm saying a breaker block is a failed order block. It occurs when price sweeps liquidity past a key level, then aggressively reverses in the opposite direction and breaks what market structure or changes in the state of derivative. So what are we saying again? Bullish breaker is an up close candle, right? Within a swing high that was formed before price swept liquidity low, followed by a rapid surge to higher high when price returns to this zone. It acts as old resistance or support. All right. So let me take you back here. If price came and closed above here, okay, after taking out this low here, we will consider this point as a breaker block, not as order block. Okay. Same applies to this one here. If price, when it was dropping here, came and closed below, we will consider this as a breaker block now, not as an order block. So the bearish one, you are saying when a candle within a swing low that was formed before price swept the buy side liquidity followed by a heavy drop to a lower low. When price returns to the zone, it acts as body support or resistance. So let's look at breaker versus mitigation blocks. A breaker block always sweeps liquidity, takes out a swing low before reversing. It's very important. So we want to see liquidity sweep before respecting that order block. Okay. Then a mitigation block first sweep liquidity, makes lower lows and lower highs before breaking structure. Okay, so the mitigation block does not sweep liquidity. Okay, so not all breaker blocks may sweep liquidity. Okay, so let's come and look at this. Let's look at this example here. What happens? We are in a bearish market. Okay, we know that when price comes back down here, it's supposed to buy and then continue higher. What happens in this case? Okay, price comes, breaks below this. So this is now no longer a what? An order block. From this point now it becomes what? A breaker block. Okay? It's no longer an order block but a breaker block. What again happens here? Let's look at this point here. Price is bullish, okay? It retraces a little bit. We know that now. When price returns here, we are supposed to see a drop. But what happens? Price now returns, comes up, but when it returns up, it breaks up. So now this is no longer an order block. It turns from being an order block to a breaker block. BB is no longer now a BB to a, it's no longer an OB to a BB, from order block to a breaker block. All right. Okay, let's continue here. So let's look at the features or the characteristics between a breaker block and an order block. The primary function. Order blocks, okay, offer trend continuation, retracement entries. So they show you the trend is still continuing or the direction of the market it started is still valid, and they are used for retraced entries if you want to enter the market. All right. Then the breaker blocks, you are saying these are areas of reversal. Okay. So now after liquidity has been taken out, we want to see price coming back, okay, and now reversing that direction from where it was going. Okay, we want to see now reverse happening. So liquidity context. Order blocks, they respect current market structure. Okay, Breaker blocks form directly after liquidity sweep. Very important. Dynamic market dynamics, okay? This is a fresh institutional limit order fill. So the market returns to fill orders that were at that point and continues to the direction it's supposed to go. But then for the breaker block, trapped traders mitigating bad position at break even. So this is for trapping, while this is for institutional fill. This one is for trapping people. Breaker block, it traps people, like it offers people a false order block, then turns into a breaker block. Entry targets. Open, you can enter the open of the OB or 50% midpoint of the order block candle. All right. So then for the breaker blocking, high or low boundaries of the broken swing high candle. Well, we shall look at that on the charts later on. Okay, let's continue down. So let's look at the Fibonacci. I wanted to pack this together so that it's a complete lesson now, because these are supposed to be two different modules, but it's important now that I pack them in one video so that we are good to go. So we are saying Fibonacci and standard deviation. Fibonacci ratios and standard deviations, okay, projections are core mathematical tools used to measure market pullbacks, forecast price expansion, targets, and identify key institutional reaction zones. All right. So they help in identifying how far a pullback can go, how far the market can expand. All right. So for now, we're going to start with the Fibonacci. We're saying the Fibonacci levels use golden ratios, okay, which are mathematical, which help to predict where price will pause or reverse during a trend. So the key points of the Fibonacci, we have the 50% Fibonacci, which is also called the equilibrium, the middle ground or the midpoint of the Fibonacci. Okay, it's called the equilibrium. Others may mark it at 50%, others may mark it as 0.5%. Whichever case you may want to mark it, it doesn't matter, but as long as it's 50%. Okay, so it represents equilibrium price below 50 or 0.5%, 50%. Below is the discounted zone, and above it is the premium zone. Okay, so let's look at this here and here. This here. Above here, above 50% is premium. Below 50% is discount. Okay, and then we have what we call the optimal trade entry points, where we have the zero. Others consider now the 61.8 or the 60% as their key point. Others consider the 70%. Others consider the 78% of the Fibonacci as their entry points, depending on how your entry model works. Okay, these are optimal trade entries. I don't want to go into this. These are another complete stuff. Optimal entry, it's another complete stuff of its own. Okay, but let's for now focus on the premium and the discount. All right, so we buy in the discount and sell in premium. So if this is a bullish market, right, is a bullish market, we start from here, we go up, we come down, we go up, we come down, creating higher highs, higher low, higher high, higher low, higher high. We break above the premium zone. Okay, price moves up. We want to buy in this area, discount zone. So if you are buying, you want to buy from here in this discounted area. Is the discount. You don't want to buy above here, because here you'll be in the premium of the leg, okay, or the trading range, but you want to buy from here. So we buy below the 50% or 0.5. Now again, if now the market is bearish or selling market, is creating a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and then we want to sell in the premium zone. Okay, we want to sell from here. Note again, selling below here. Why? Because if you sell below here, you are selling in a discounted zone. of which you have higher chances that price may retrace against you. Okay, because you are selling in a discounted zone. All right. Okay. Let's look at standard deviation projections. All right. They are saying standard deviation measures volatility distance relative to a central mean or a key manipulation move, like liquidity sweep of the leg. Okay. So now, most people when they are trading, they are like, where am I going to take my TP from? Where will this price expand to? Okay. Some people they don't know. For example, if you are trading Nasdaq, in most cases, you want to be able to see an area of take profit because sometimes it's bullish and you don't know where it may react from because there is no any other level above you. Okay, so that this is where now the standard deviation comes in. Standard deviation measures the volatility distance. Listen to this. Measures the volatility distance relative to the central mean or a key manipulation move like liquidity sweep. Okay, measures the relative distance. Let's say this was an accumulation. Liquidity was resting above here. We sweep it. Okay, so what we want to answer is that the distance from here to here, okay, should be the same as the distance from, again, coming from up to down. Okay, and again from here to here, the answer should be the same distance from here to here. Again, from here to here should be the same distance from here to here. So answer that price is likely to react from there. Same applies. The distance from 0 to 0.5 is the same as the distance from 0 to, to 0.5 positive to 0.5 negative, which I didn't include here. Again, from, let's say there was 1.5 above here, is the same distance from 1, -1 to -1.5. Okay, so price will always try to respect these zones. You try to always respect these areas. Okay, always try to respect these areas. I always try to respect these areas. Price will always try to respect these areas. So as we can see, price is trying to dig in deeper. All right, we will move. So let's say if you didn't have take profits from the downward side here, okay, you didn't know the level where, for example, Nasdaq or the pair you're trading may react to. You want to take profit either at -1, -1.5, or -2 or -2.5. These are points of taking profits, right? I use them to take profits. Okay, so with -1 to -2, okay, these are the first algorithmic expansion zones, ideally for scaling our partial profits. We take our partial profits from between this and this point. And most of the price we try to, it always tends to move to -1 and -2. All right. -2 to -2.5, high probability target zone where price frequently exhausts the daily expansion. So if we were in a daily range, we could expect price may start getting exhausted at -2 or -2.5. So at -2.5, before you reach -2.5, you must only believe maybe a runner, but when you have taken the majority of the profits of the table, like 20% left in the trade. -4, terminal exhaustion point, price rarely expands beyond -4 standard deviation without a deep pullback. So it rarely reaches -4 without retracing back up. But if it again reaches -4, it means the price is going to continue in that direction aggressively without reversing for a time. Okay. So how it's applied, drawn from the high or low of a key leg, such as initial consolidation prior to the displacement. Initial consolidation prior to the displacement. Initial consolidation low prior to the displacement. Okay, let's look at this here. What happens? We are from 0 to 1 here. Okay, so we answer that price puts in a fair value gap here. Then when it comes down, it invalidates this fair value gap. All right. When it invalidates this fair value gap, it puts in a breaker block here, which was an order block that was left before this move. Okay. So now, when we invalidate this order block, another one can enter and you swing your trade up to the low. Let's look at a good market example here. Let's look at this trade I want to here. Okay. What happens? What happens here, right? I mark the low to the high. Okay. From this swing low to this swing high here. So I anticipate that when if I'm entering from this fair value gap, price is likely to come to -1, okay, and above. So what happens? What do we see here? We see now it's the same thing here. Price comes, activates my entry, moves to -1, TP1. What happens? It reacts on -1, consolidates a bit. All right. I take another entry. It moves from -1, reacts at -1.5, as you can see, and then moves up to -2.5. Same stuff, same stuff, same stuff, same stuff. Just simple, keeping it simple because there is no clear take profit level. Okay. So let's look at the comparisons. The primary use, okay, for Fibonacci retracement or extension. It is used for measuring deep pullback zones. Okay. Let's say if the price has been moving like how we saw here, you want it to know where how far it may retrace. So we want to see it retracing back into the premium zone, which is in a bearish market. Okay. And then for standard deviation, it is measuring statistical expansion from a sweep or range. Okay. How far is price likely to go? All right. Anchor points. Major swing high to swing low. All right. So we plot it from the swing high to the swing low, as you can see here, from this swing high to this swing low. Okay. And then this one we plot from the manipulation leg or consolidation range, high and low. Okay. Mm-hmm. Core benefit, visualization of premium and discount pricing. Objective, okay, objective reprojects terminal price targets based on volatility and take profits. So now let's try to go on charts and try to sum up all the things we have been looking at in this lesson on the charts together. Let's try to identify this order blocks as a trade I took last week. Let me first remove this. So let's try to identify these order blocks and breaker blocks. Let me just use this for hand here. Okay. So, what do we have here? How can I identify for me by your eyes an order block? Okay. So what we have here? We have this. The last we have this small pullback here. We have this last selling candle here. What happens? We expect that when price comes back into this zone, let me try to zoom in. Okay. When price comes into this zone here, just a second. Okay. We expect that when price comes into this zone here, it's supposed to react, right? What happens? When price comes in, when price retraces up into this zone, it reacts, pushes up, right? So what happens is we see a break of structure to the upside. So we have a BOS break of structure to the upside. Okay. So just a second. Um, So we had a break of structure to the upside. So when you have a break of structure, we see price retracing back into this order block, okay, which is again aligning with the fair value gap here, okay, this fair value gap here. Price taps into it and pushes up. Now, what happens when we inverse it here? What happens when we inverse? Now, this no longer becomes a what? An order block, but it becomes a breaker block. It becomes a breaker block, okay? It's no longer an order block. Now, turns to be a breaker block, okay, as you can see. Now, when we react, okay, if we break this, it becomes a breaker block. But I want us to look at something. I want us to look at something here, okay? The last selling candle was this one, because this one already served its purpose and it created this move. So now expect this becomes our last selling candle here, this black candle. Except when the price comes back here, this is going to be our new order block, okay? This is going to be our new order block. Expect that when the price retraces back here, it's supposed to go continue higher. But look at what happens. Price when it retraces, it breaks it, okay? It breaks it. So now that means this becomes our breaker block. So in price retracing back into this breaker block, we expect when price retraces back into this breaker block, we expect to place our sales here, okay? Because price turned this order block into a breaker block and broke market structure here. We broke what? Market structure here. So when you broke this market structure here, price pulled down, okay? Price comes and retraces back into it, giving us this move here. That dropped down, okay? Short position would be here. So close above, targeting any point here, okay? So what again does it match with? So if you try to put in our Fibonacci from the for this range here, this consolidation range, what do we see? We see price pushing to -4 zone, okay? Price moves to the -4 zone, and we say -4, price normally creates what? Exhaustions, okay? And we see price now trying to pull back into, again, this breaker here, and we continue lower and lower, okay? So let's try to look for other examples. Let's try to look for other example. Let me try to choose some right lengths. Okay. What do we again have here? Price was pushing down. It retraced, left this order block here. Okay, it left this order block here. So this becomes our order block. So we expect that when price now retraces back here, all right, it's going to sell again. So we see price pushes down, retraces back into this order block and then sells. And then if we see the high of this move is from here to the low of the move, what do you see? You see this order block is within the premium zone. We said above 50% is premium and below 50% is discount. That's how now you can see that in this move here, we are selling in the premium zone. So we are selling in the right zone. That's number one. We are in the premium zone. Number two, we are inside the order block. Number three, we have short liquidity. And then you can see price now derive from here and continues lower. Okay. Let's try to look for others. Let's try to look for other order blocks here. Okay. Let's look at this example again. What happens here? Okay. What happens? Price is trying to retrace a little bit up. What happens? we put in this order block here, the last buying candle, okay. Now we know that when price retraces back into this candle here, it's supposed to do what? It's supposed to sell. What happens? Price comes down, retraces back into the candle, and we see now it creating this sell here. But it's short-lived. What happens? It now comes and closes above this level here. Comes and closes above this level, printing for us a clear break of structure. A body closure. Remember we said for break of structure you want to see a body closure. Okay? Or CISD. It prints for us the CISD here, changing state of delivery from bearish side to bullish side. What happens? We close above it. Okay? Price comes back and retraces. Now this turns from being an order block to a breaker block. It turns from being an order block to a breaker block. Okay? So we see it's now no longer an order block, comes a breaker block, price comes and gets into this breaker block and goes higher. So there are some inducements here. So we can see price swept this low. It swept this liquidity. Said a breaker block sweeps liquidity. We see liquidity sweep here, and then price continues higher. Same applies if you are considering this. This will be another block. Price comes and pushes down, retests and continues lower. What again happens here? The last bullish candle was this one. Okay, we expect that price should come and retest it. Okay, price should come and if it tests here, it should sell. But what happens? Price goes through it. Okay, it goes through it, creating this break of market structure here or change in state of delivery. So we see this change in state of delivery at this point here, from bearish momentum to bullish momentum. What happens? When now we put in this, we close above this point here. This changes from being an order block to a breaker block. Okay, changes from being an order block now to a breaker block. Okay, now when changes from being an order block to a breaker block, price comes and retests into this zone and continues higher. Now see this and continues higher. So it goes on like that. It goes on like that. It goes on like that. So let's try to look at something else again. Okay, let's try to look at something else here. Okay, so we are saying, all right, if you are in a downtrend or if you're in a bullish trend, you want to buy or sell in premium or discount, right? So these highs, you mark at them. Time is fractal. That's one thing I want you to know. Time is fractal. It can be on the higher time frame, can be on the lower time frame, but just know time is fractal. It can act from any point. It can act from any point. So let's look at this high to low. You want to sell from here, from this point, which again aligns with your fair value gap here. Okay, you want to buy, to sell from this point and buy below here. You want to sell above here and buy below here. That's why you can see price moves into premium, it traces into discount, and then continues higher. Okay, so let's try to mark this again. What do we have? We have this our high. Very slow. You mark from the high to the low. So the high is here. This is the high. Okay. What do you want? You want to sell from this premium, okay, and buy from this discount. What happens? We shoot into the premium, you sell from here, and then you buy in the discounted zone here. All right, let's look for another one. We have this retracement here. You want to sell from above here and buy below here. So that's it. That's it. That's it. Then for take profits, right? You want to take partials in negatives. Negative one, negative two, okay? Negative one, yeah, you can take partials. Negative two, you can see price is trying to react at negative two, negative 2.5, okay? In case you didn't have an area of taking profits. What again do we see here? From this high to this low. You want to buy below here, you want to sell above here. And then you can target like profits below here. What do we again have here? You want to sell above here and you want to buy below here. Premium sell, discount buy. What do we have here? Again, you want to sell above here and you want to buy below here. So this one we are in a bullish market. In a bullish market, you mark from the down to up. In a bullish market, you mark from down to up. Okay. Okay. What do you want to see? You want to buy below here and sell above here. In a bullish market, we mark from bottom to top. We mark from bottom, we want to sell above here and buy below here. So it goes on and on and on and on and on and on and on like that. It goes on and on and on and on and on like that. Okay. So this low to this high. What do you want to see? This is the current high we are having here on the H4. Okay. Price made a trace back into this discounted zone, and then you can continue higher. Check high to low. You want to sell above here and buy below here. Okay. That's for a bearish market. And for a bullish market, what do you want to do? High, low to high. You want to buy below here and sell above here. So you can see we reach into the discount here, we buy. We reach into the premium here, we sell. Okay, again, what happens here? High to low. Okay, discount we buy. Discount we buy. Premium we sell. That's like that. That's like that. Unless you have any other questions, we shall dive deeper onto the charts. I don't want to tap into standard deviation a lot because we are going to look at them when we are compiling everything and trying to look on how to take trades. For now, take that, but standard deviations are used for take profits. Another thing I can try maybe to go through with you on standard deviations is this. Let me try to go on my M1. Okay. All right. So let's say which time was this? Is Friday, right? see trading. Something I'm looking for here on trading. Okay. So let's say we accumulated here. All right. Then we manipulated lower. Okay. We accumulated, manipulated lower. This was the manipulation leg here. Okay. We manipulated lower and we put in a CISD here, changing state of delivery, showing that we are coming from now bearish to bullish. We put in a CISD here. Okay. So the question is, if you take this trade from the retest of this fair value gap here, okay, if you take a trade from the retest of this fair value gap here and you don't know where to take profits from, how do you do it? So now look, now what we are going to do, okay, we are going to mark, all right, we are going to mark the range, okay, we are going to mark the range of our retest, okay. This is our low to our high. From this point, which is the low, to our current high, which is here. Okay. And then now we want to take profits at these points here. -1 can be take profit 1, -1.5 can be take profit 2, -2. You see, these can be our take profits here. Even -0.5. Let me try to add it on. -0.5. Let me put here. I'm going to make it -0.5. -0.5. -0.5. You see how it matches with this high? And price reacts as -0.5. -1 is here. Okay. -2 matches again with this high here. And what happens? Price reacts from -2, drops down. So if you took a trade from here, from this retest, okay, of this zone or breaker. So again, let's look at this. The last buying candle. Now let's combine many things here that you have learned. Okay. So we know the last buying candle was an order block, right? This was an order block. So an order block here. So what happens? Price comes and breaks it and turns it into a breaker block. So let's say even if you bought from here, from the radius of this breaker block, stop loss below this zone, the manipulating leg, or you can target, this is 1.5, 1 to 1 point, it's 1 to 1.5 risk to reward, which is not bad, at 0 point what? At -0.5 TP. You have 1 to 2 at -1, and then you have a overall of 1 to 4 at -2. You see now how you can take profits using this. So this is what I use my standard deviation for. You see, combining all those things, CISD changing set of delivery, breaker block, which we started, which was once an order block, Fibonacci. Okay, again, let's put in the Fibonacci and we see this is our high, this is our low. We want to sell from here. Okay, we buy from the discount and we sell in the premium here. See, price now changes the premium, matching with our -2, again it starts selling. Simple as that. Okay guys, that has been our lesson for today. Hope you enjoyed this lesson. If you have questions, or for those who are in our WhatsApp group, we shall have this lesson discussed on Sunday. Don't miss out. Let's keep learning until we win. For now, we love you. The next lesson is a banger. We are diving into liquidity, the long awaited thing. We are starting it next week. So, liquidity is going to be our next lesson. Big up, much love, peace for now. Until we meet again, bye bye.